So hello everybody and welcome to Chloethedev Unfiltered. We're doing another paper review and happy Halloween week. So all this week I'm going to be going live in my wonderful unicorn costume. Meeksies and I are matching. I'll try and share a picture of that at some point. But on my Instagram and stuff I have pictures of us matching. Today's paper is the Eth2 Economic Review. And we are going to be starting at chapter 10, hopefully finishing off the paper with chapter 10 and 11. I did want to go through the appendix. I might do that tomorrow. The bibliography and the appendix and all that. I do want to look through the different papers that were used and where the information came from. But this is going to take a little while. I got about 20 pages to get through. Should be a lot of charts and graphs, but let's get started on page 66. So yeah, usually Meeksy and I are out. Mika, the puppy, and I are out pretty much every day skateboarding around the river. Usually I'm wearing one crazy outfit or another. But for this week, the crazy outfit is going to be the unicorn costumes. You know, it's pretty cute. We go around, people laugh and smile, and I'm sure some people get annoyed at us, but you know. We do what we can. So, starting with chapter 10, Scenario Analysis. If you'd like to go through the rest of the paper, please feel free to read it. The paper link is in the description of this video. As well, I've gone through the rest of the paper in videos prior to this. So, in the playlist for this video, you can go back to other videos as well. So, in this section, we apply the various frameworks articulated so far to assess risk in 5 different network scenarios, where we make adjustments to the base model assumptions. Informed by the takeaways in this report and our stakeholder interviews, and try to understand the network impact of said adjustments. Our primary objective is to paint a more comprehensive and useful picture of the network's conditions under various parameter changes. Below, we recap these frameworks and how they will be used in this analysis. Okay. And apparently they use the Durbit exchange for their options pricing above here, which, I never used it personally, but I've heard of it and some good enough exchange for derivatives, options and all that. Framework for evaluating network security, where the cost of attack of the beacon chain must be equal to or greater than the economic gain derived from the attack. The cost of attack on the beacon chain must be equal or greater than the cost of an equal or corresponding attack on the Eth1 chain. Again, just trying to make sure that attacks on Eth2 aren't economically viable at least, and they're at least as expensive as they are on Eth1. Using the target ETH stake rate from the prior section, which we determined to be 13.8 of the total ETH supply, or approximately 15.5 million total ETH staked. I think right now it's about 120, 130 million ETH total supply, around there somewhere. We calculate the implied yields and set of assumptions around the network state. Every time it happens, when I start doing paper review, I start yawning, but it's all right. So framework for evaluating required validator yield. So where the required rate of return for capital efficient validators is determined by considering the economic risk of becoming a validator. So again, we're differentiating here between capital efficient validators and what is it? I call them altruistic nodes, but they called them yield apathetic validators. I think yield apathetic is a bit, I don't know. Altruism, I guess, has the same definition, but different psychological, thoughts based on the context of the words. Using the R-Savvy model, I can't remember what it stands for, but it's a long phrase, just helps you figure out validator yield. Required something, validator yield. The set of assumptions used to calculate a bull and bear case yield, and the output of these assumptions, we can compare and contrast expectations around liquidity, volatility, revenue net yield spreads, opportunity cost, and network health. In the preceding scenario analysis, we follow the following structure to assess each scenario. We have a scenario background, which is the rationale for analyzing this scenario. We have the adjustments being made to the model's based assumptions. We have the network assumptions, what you need to believe about the network conditions and their comparison to the R-Savvy bull or base cases. Network assumptions is just saying the fake world we're making in this network. You've got to assume these things are true for the scenario to play out. And then network analysis and takeaways. It's really hot in this. Sorry, I'm gonna put this up a little bit and then unzip this a little bit because oh my gosh, I am like burning up. This is definitely made to be worn outside, which is great because I gotta go skating it soon. 3 region analysis based on price to determine areas of risk and key takeaways from the scenario. We analyzed the following 5 scenarios: reaching Genesis, which hopefully will happen soon; reaching target ETH staked, which I think will happen very quickly after Genesis on mainnet; reaching target ETH staked, increasing base reward factor; reaching target ETH staked, larger adoption for STAS providers, so like Rocket Pool I would assume, or other types of STAS I suppose; and reaching target ETH staked, EIP 1559, different fee market for Ethereum, and 10x the current gas levels. And we'll go through each of these scenarios quickly. I'm going to take that off too. Gosh, it's hot in here. Being a unicorn is tough. Yeah, so we're going to go through these scenarios and just quickly, there's lots of graphs and stuff. So we're going to quickly I'm not going to go through every single part of each graph. If you'd like to do that, please come through and look at the paper yourself. What I'm going to do is just make sure I understand what's happening, understand what's going on. So scenario 1, reaching Genesis. Scenario background. This first scenario reflects on the absolute minimum network requirements for the Beacon chain to launch. The genesis of the chain requires 524,288 total ETH staked, or 16,384 validators. I find it weird though, because if I had a validator that had twice as much ETH, would that then be all right? I think it would be all right, but I wouldn't get twice as much rewards, so it wouldn't make any sense. Anyways, it is instructive to obtain a view of the network that is at its most elementary state, and form a bookend for our scenario. So we're starting all the scenarios with a very basic state of Genesis. No one's gotten any rewards yet. We have this much ETH staked, and then we get started. So under these assumptions, we're going to assume there's at least this much. We're going to assume yield is 11.6 in the worst bear case, but going as high as 21.8. Liquidity, there's semi-liquid secondary market, and then I guess illiquid secondary market. So I guess the bear case. Interesting. So volatility, an increase in volatility compared to the bear case, and then in scenario 1 you'd have high volatility. You'd have high demand for borrowing, Eth for arbitrage. High demand for borrowing, yeah. Cost of validating 2%, okay. And then risk of penalties, 90% of validators online with few inclusion delays. Clients nodes operate flawlessly, and it's saying scenario 1 will be similar to the bear case. Network analysis and takeaways. The revenue yield at 524,288 ETH staked is approximately 21.8%, with network average net yield stabilizing based on ETH price near 20.5% and 0.1 annualized inflation rate. Also with EIP 1559, that could be lower, but anyways. We also expect a high level of volatility given the proximity to launch and the low level of ETH staked. At this part of the curve, the cliff shows wide fluctuations in yield. So this is the left side of this graph, showing this little cliff here, over here, and showing how at low ETH prices, you kind of get into this really volatile yield. Given the low level of ETH staked implied in this scenario, there is a concern around security of the network from supermajority and finality attacks. However, we expect the high yield to attract capital-efficient validators. So they're saying that the low amount of ETH staked can cause security issues, but there's no transfers or anything. So we talked about it previously. Those security issues in phase 0, phase 1 shouldn't be too big of a deal. Also, capital efficient validators who want that 20% and don't mind potential finality issues will probably be would love to validate, and as their stake will come down over time, or their yield, sorry. But they're already going to be getting that 20% for a while. And if there is a strong semi-liquid secondary market, even with a 5 to 10% spread, those people, people who are getting 20%, as we see here, returns, will be able to sell, take a 5% cut, and still be well within a good amount of yield. So that's the idea here. The idea is the high yield will attract capital-efficient investors, which will also bring up the network security, which will bring down the yield, but by then you'd hope that there was a strong, robust network. Scenario 2, reaching the target ETH staked 13.8 of the network supply. In scenario, so get some background for the scenario. In section 9, we derived an ETH stake rate target for the network's ETH stake rate of 13.8%. In this scenario, we obtain a view of the network under this ETH stake rate without making any other adjustments. So all they've done here is you're comparing to the bull case to this scenario of 15.5 million ETH stake. So again, to start the chain, you need 524,288 ETH, I'm pretty sure. Yeah, 288. And then in this scenario, you have 15.5 million ETH, which is the 13.8%, which is where you get some strong security. The revenue yield is actually maybe a bit higher than the bull case, because remember, in the bull case, you have more networks and your yield's lower. Very liquid secondary markets. Yes, you'd assume you'd have very liquid secondary markets, 15.5 million ETH staked. Volatility would be the same. No change in demand, increased demand. Cost of validating 1%, which would be yet less because, I guess we're saying ETH is higher and your rewards are higher. Risk of penalties and slashing. So we're saying 98% of the validators are online. So there should be very less risk of slashing in this bull case, So network analysis and takeaways. Revenue yield is approximately 4% with network average net yield stabilizing around 3.7% with a 0.55% annualized inflation rate. Again, it's kind of hard to know what that inflation rate will be until we look at EIP 1559 at the end. We see the RSAVI model's bull case as a highly optimized state of the network. This scenario falls very close in line to this case and is centered around achieving adequate security. To achieve it, we believe it will require the participation of capital-efficient investors, validators, most likely taking the form of institutional investors. With that, we expect a few requirements to apply, including full liquidity, low volatility, and low opportunity cost. And so, again, if you want institutional investors to get on board, there needs to be low barriers to onboarding, and also low risk. Institutional investors are not going to come into a very volatile, risky platform, and this is why one of the large reasons why I really enjoy providing liquidity on Uniswap, for example, for ETH to a stablecoin, is because it increases this or it lowers the volatility of ETH in general. The more funds you have pegging ETH to any dollar amount will lower the volatility, and I think that Uniswap alone is going to provide a lot of price stability for ETH. I think it's already doing so. When you have billions of dollars being tied to liquidity, keeping an asset's price stable, and moving that asset by even $1 takes so much volume. It's a good thing for security, especially for ETH2. Scenario 3, reaching target ETH staked, increasing the base reward factor. So I think now we're talking about doubling the base reward factor from 64 to 128, as you can see for the adjustments here. As with the prior scenario, we target our ETH stake rate in this scenario, but we also increase the base reward factor from 64 to 128. We explore this change based on our own conclusions from analyzing attack vectors, as well as in response to feedback from a material number of stakeholder interviews. We expect this change to result in stronger security guarantees without leading to overpaying for security. And I think this is great. I think in ETH Phase 0 especially, you should be paying the validators who are willing to come on board and help secure the network. They're not getting anything in return, arguably. They're getting ETH that's locked for who knows how many years. So, and then this reward factor will still come down when more ETH is staked, and it shouldn't cause too much of an issue, especially with the fee market from EIP 1559 changes. So anyways, in the bull case, we have high levels, okay. Revenue yield now is 8%. At that number. So in my opinion, if I was getting 8% at the optimal yield number here, I will be very happy as a altruistic node. I'm not even doing it for capital efficiency, but I mean, that is more than double what we were looking at previously. Slightly less liquid than the bull case. I would assume this is because you're going to have more. I'm actually not sure why we would see less liquidity. I would think that arguably you might see more liquidity just because you have more revenue, I guess, being generated. And so therefore, people are going to be willing to get rid of it at a lower price. There's going to be more people willing to purchase these assets at a lower price potentially, or I would say there'd be more volatility as well in terms of what the ETH2 derivatives, but we'll see. Volatility in terms of staking, yeah, again, slightly more volatile. I would see that. Again, I'm not sure I'd see less liquidity, but these are the professionals, not me. High opportunity cost of lending, no change, and then high demand for borrowing Eth for arbitrage. Yes, the higher you put the yield, I would consider the demand to be increased because people want that demand. They want that yield. Sorry. Cost of validating is the same, and risk of slashing is the same. Revenue yield is approximately 8%, with network average yield stabilizing around 7.5%, with a 1.11% annualized inflation rate. So 1.11% annualized inflation rate is double the inflation rate from previously. Where was it? Here, 0.55. But again, with EIP 1559, potentially that smooths out. At the expense of 56 basis points of the network inflation per year, or roughly 627,000 ETH, which is about $125 million at Ethereum being 200. So right now it would be about $250 million or more. We believe the higher yields make our ETH staked rate target of 15.5 mil more achievable than under the current specs. At a base reward factor of 128, there is far more leeway for abrupt and large changes to occur on the network. Yes, I agree 100%. Such as an increase in volatility due to a protocol change, less liquidity given the amount in circulation, and the likelihood of competitive yield alternatives to arise. Given the low downside of this scenario, we find this adjustment particularly compelling. I agree. I don't see much of a downside. I see the downside being increased inflation of a very low amount, which, I mean, the inflation increase, sorry, the inflation that's here of 1%, arguably in general, in my opinion, is well within reason for a blockchain. I mean, I would assume that 1% of ETH is lost every year just in wallets that people lose keys to and people losing dust in different areas. So I would say potentially maybe around 1% of all ETH is lost every year. Okay, that's a lot though. We're talking about 600,000 ETH lost a year. Okay, maybe it's not that high. But it's probably like maybe 0.1% ETH lost a year. I don't know. It's up there though. I remember I'm reading about it on Bitcoin, about how much Bitcoin is actually lost forever. It's actually quite a bit of Bitcoin is lost. ETH is a bit different, and ETH2 will be definitely different. The UI, the UX for customers or for users, I expect to be a lot better than what we saw in Bitcoin in 2010, whatever, and especially with Ethereum in the past few years. But anyways, now we're going to look at it with large adoption for STAS. The inability to withdraw and/or transfer Beacon Chain ETH significantly dampens on-chain liquidity, and this is where I think that this case. I think we're going to see huge amounts of STAS providers in the ETH2 network. A multi-year lockup period with no definitive end date will be a major block for institutional investors in particular. It's a lot of risk, given more stringent capital allocation requirements and possibly even enthusiasts. Okay. Our conversations with stakeholders, including the co-founder of a decentralized staking pool, indicated this is a leading concern for the Eth2 network, ETH2 network. On-chain transferability limitations do not expel every possibility of Beacon Chain asset liquidity, however. Centralized exchanges as well as asset managers can offer inter-platform tradability and/or structured derivative instruments. We believe these structured products will be a much more attractive opportunity to capital-efficient ETH holders than running a complex validator environment. Agreed. Suggesting a much larger allocation of network validators into the STAS full environment relative to what is indicated in user surveys we reference to determine validator allocation, which impacts yields in our model. In other words, increasing the number of capital-efficient validators, which we see as a requirement to get to the target ETH stake rate, will require a shift to a larger proportion of fully managed STAS validators. And I love this because you're going to need a lot more individual STAS validators. I'm going to have to run Rocket Pool node. And with my Rocket Pool node, Rocket Pool kind of manages my node for me. So I become a stash provider, but Rocket Pool manages my provision for me, which makes it a bit easier. But what they're doing is adjusting the share of validator environments. So pretty much, instead of having, this is the base assumptions for DIY, and now they're dropping it to 12%. DIY Cloud is being dropped to 4%, I think, and then Pool STAS is being dropped to 9%. Hardware dropped to 4% for Pool. Pool Cloud dropped to 1%, and then STAS Full up to 70%. And this is what I'd love to see. I'd love to see more nodes like this, but 8 to 70% is a big change, but let's see it. And they dropped the yield back to 4%. Liquidity is very liquid. Yep, same as Bull. Volatility, highly volatile. It says no change, but I guess it should say, no change. We don't know how volatile it's going to be. Opportunity cost, no change. And they're saying that there would be an increased demand, which I would agree, because with all these pools, there'll be so many derivatives that, cost of validating is 1%, and now the cost of validating is marginally higher in this bull case. I guess slightly lower risk than bull case. I guess you'd have a less chance of getting slashed because something like Rocket Pool would be like servicing your node for you. Would this cost of validating be a bit higher? I would assume, because running a node on your own, you only ever bear the costs of running the node and the hardware. Whereas even with Rocket Pool, although I'm not sure this is true, because something like Rocket Pool, if you do run your full STAS node, you will actually gain fees from the network. So the cost of validating could actually be lower, and the cost of getting slashed could be higher, because in the previous network that they were talking about, I'm assuming you're running your own node on your hardware, and so your risk of slashing would be, whatever like risk you had of getting slashed, and do something wrong, getting hacked. Running a node with Rocket Pool, your risk of getting slashed should be lower, but could be increased because you share your balance with the entire pool. So if one node gets slashed on the other side of the world, all nodes lose rewards at a similar level. So might not be a big deal. Might be a big deal. I'm excited to try it out. Network analysis and takeaways. Revenue yield remains the same at approximately 4%, but with network average net yield stabilizing near 3.5 versus 3.7% from base assumptions, and with a 0.55 annualized inflation rate indicating a low impact in net yield. So the changes that were completed will not change the net yield of the network drastically. Other than a marginal impact on net yield, the dramatic shift to the model's allocation of validators to fully managed stash environments has very little detrimental effect to the economic outputs of the network. In fact, even at an ETH price of $25, validator environments are still profitable at 15.5 million total ETH staked in the network. Awesome. Unlike the prior validator allocation. So this is where, in my opinion, it's pretty cool, kind of saying that like even at a lower price of ETH, using a STAS environment, and this is saying, fully managed STAS environment. I'm assuming they're talking about managed by someone else. I'm not really sure. But with Rocket Pool, I would consider that I guess it's not fully managed. I'm not really sure, actually, what they differentiate between fully managed and what. Because with STAS, you have like exchanges that run some STAS stuff. You have non-custodial. You have Rocket Pool. You have all different types of STAS providers. So earlier in the paper, it did differentiate a little bit between the two. But what I would love to see is more of a differentiate between. You can't just call everything a STAS provider. There's different. There's a range in that definition. This change in profitability occurs because the costs are shifted to the infrastructure providers. Okay, so this is talking about, for example, me running a Rocket Pool node, and then other people only holding our ETH. And so if someone's only holding our ETH, they're arguably still validating in some way. without having to run any validating software. And so the cost is slightly lower to that individual. While the cost, the end user, are represented as a percentage of total rewards. So you, in this sense, you're only paying a cost out of the rewards that you would have gotten from validating. Infrastructure providers bear the fixed cost of validating. So I would be some sort of a halfway infrastructure provider, which could damage SaaS profitability and longer-term sustainability. I think this will not be an issue because Rocket Pool and systems like it. So I'm really hoping that we see a similar system from Nimbus, from the Nimbus and Status teams on Ethereum. But what this could allow is for altruistic beacon nodes, for example, to allow any number of validators to connect for free. And this would allow those costs to be lower. So instead of charging validators, 5%, I could charge them like 1% or 0.5% just to keep the node up and running. Our key takeaway from this scenario is that SaaS providers add significant benefit and downside protection to the end validator. Woohoo! Suggesting the contribution of more stability and critically liquidity. That's part of the reason why I want to do it as well. All these wonderful reasons. We see centralization risk playing a factor, particularly if ETH drops into a cliff region and SaaS providers incur extended losses, forcing them to shutter and exit their customers' stakes. I love Rocket Pool's system for this is because Rocket Pool makes me, as an infrastructure provider, also put up 16 ETH into these nodes. So if I just walk away one day, I also walk away from my 16 ETH and I will get slashed as well. It could still happen, and I'm sure it will still happen, but I mean, you'll be slashed. Like, you get slashed as well. So again, I'm not sure how that'll play out, but again, this is more if ETH drops off a cliff in some unforeseen circumstances. I doubt these things will happen. Definitely possible, and so preparing for these eventualities is important. Centralization risk also increases the potential impacts of key mismanagement or hacking exploits. So again, the beauty of this is that with Rocket Pool, for example, all the keys are held by individuals who provide infrastructure. So I have my own Rocket Pool keys. I'm running 3 Rocket Pool nodes, or I was. Running Docker containers is not easy and not fun. But I did a few videos as well on this channel about setting up Rocket Pool nodes, setting up NIM nodes, and all that. So if you'd like to try Rocket Pool setup, you can win some Rocket Pool tokens for testing that out. Also, if you would like to run a NIM node or a Prism node or a Lighthouse node or whatever, I do have a walkthrough of setting up a Nimbus node for Eth2 on Madasha. This is the same, we keep seeing this is the yields by total ETH staked under a stash-driven network. Similar graphs all the way around. This is what I'm really excited to see. So now we're talking about EIP 1559, higher gas levels, and all that kind of stuff. So EIP 1559 could have a sizable impact on total ETH issued. And so this is what the most important part, in my opinion, of EIP 1559 are twofold. On ETH1, I'm happy to finally have it where I know the gas price to be included in the next block. That would be awesome. Second of all, I think keeping issuance of ETH as closely tied to the minimum viable issuance for security is important. So in EIP 1559, a portion of the gas used, the base fee on the network, would be burned instead of redistributed to the miners or validators. This proposal, in turn, could reduce inflation or even deflate total ETH issuance as a result of proof of stake's lower cost structure for validating network activity. So EIP 1559 on ETH1 would be great for the new ETH market, new gas market, but for issuance should bring down the issuance and make it closer to a viable issuance level to maintain ETH1 security. But in ETH2, because security costs less, the benefits for EIP 1559 and proof of stake are even more pronounced, which is awesome. In this scenario, we analyze the impact of EIP 1559 in the event gas usage increases by a factor of 10 with average gas price of 1 GUE. So we're just talking about gas prices being used more. Okay, adjustments. We turn on EIP 1559, enabling gas burned and tips to miners. We set the number of transactions per day at around 6 million or 7 million, so around 80 transactions per second. And I guess the idea is that's 10 times more gas used, only because I guess we're saying that there's more throughput, therefore you can do that. And around 1.1 ETH per epoch and 91,885 ETH per year in tips to validators. And in my opinion, that is way lower than that 650,000 ETH number we saw earlier. So what we would see, again, is only this much being issued. So a lot less issuance, I would assume. But anyways, it's saying you'd actually get 4.6 instead of 4. So let's read it and see. A lot of this is just the same. Increased demand for borrowing Eth. So the revenue yield is increased to 4.6% as a result of increased rewards from tips. Okay, so these tips are being added to the validator rewards. Oh, but I guess all you're doing is you're still getting the initial validator rewards plus these tips. What's not happening is some extra gas fees going to the miner on top of that, or the validator on top of that. And no more auctions, which is great. Network average net yield stabilizes near 4.2% from base assumptions with a 0.39 annualized inflation rate. So the inflation rate is a bit lower, and I think that's from the burning. Calculated to 36 million in reduction in issuance per year at an ETH price of 200. And again, this is showing the graph, and this is showing what the graph would look like with 10x the number of transactions. So hard to know because that's not happening until phase 2, right, with transactions and state changes. So I agree, 1559 will be an awesome upgrade. It's kind of hard to test it right now, especially with, in my opinion, with phase 0. Will phase 0 have EIP 1559? I guess not. So again, scaling the Ethereum network has always been a primary focus for the community. Successfully achieving scale will unlock many use cases on the network, but could also fundamentally reshape how the network pays for security with EIP 1559. Scaling ETH by 10x to 80 on-chain transactions per second halves issuance at the target ETH staked amount and slightly increases yields. The impact at these levels are somewhat material, but the impact of EIP 1559 reaches a tipping point in the mid-hundreds of transactions per second, still assuming 1 GUI, which is a conservative estimate. So again, 1 GUI is a bit low probably, but whatever. When the protocol could operate, so in the mid-hundreds of transactions per second, the protocol could operate without any network incentives and still achieve the security at desired levels. So I think it's showing that, okay, if we have 80 transactions per second, we are looking now, and only at 1 GUI, we're looking at bringing the issuance down from 0.55 to 0.39, which is good. Again, an ETH price of $20. If ETH price went up, you'd also see increased of all these numbers. So right now, you'd probably be looking at least double that. So issuance of 0.3 issuance per year at an ETH price of 400, let's say. I'm probably not correct exactly, but let's say around that estimate. And then all you would need is, doubling the transactions per second. So you have 2 shards, let's say. However that happens, though. And then you're starting to get a burning in the issuance, so a reduction in the issuance of ETH per year, which is awesome. We illustrate network metrics at 100x current transaction levels, or 800 transactions per second, which is hopefully one day possible. But in phase 2, which is years away, 2 years away or whatever, could be possible. We are encouraged by the idea and potential cost savings that it could incur, but adoption would need to drastically increase to reach this material level of impact. I'm not sure adoption would have to increase. I just think scalability would have to increase. I mean, right now you can't get 80 on-chain transactions per second, and you cannot get 800. So I'm not sure. I mean, adoption will have to increase, of course, but I think the issue is not necessarily adoption, more so like what the network can handle in terms of scalability. And hopefully ETH2 will be able to handle 800 transactions per second, because then we'll see some amazing. So I'll look at this. So the blue line is the network inflation rate, and now we can see how low the inflation rate is. I mean some of this is kind of crazy. You can look at the revenue yields, like 200% at a certain point. I mean, but again, you're not going to see 800 transactions per second and see not many people staking. So more realistic, let's look at the total right hand side of this graph, where we have 33 million ETH staked and all that. So with 33 million ETH staked, what you are going to see is a net yield of around, I mean, it's kind of hard, but if the ETH price was very, very low, you'd be at a negative yield if ETH was $20. But let's be realistic now, and let's say your yield is probably around 3% around there, right? Looking at this 5.45, ETH being 1,500, with ETH at like 4,500, we're looking at maybe 3% per year yield, which is not the best, but it's higher than bonds and it's higher than a lot of other investments. And with ETH being at $500 to 1,000, we'll get a high ETH price. And then what's important is the blue line, in my opinion, because you're also going to see almost a 1% reduction in the total supply of ETH. Which could then add that to your yield. You're looking at 4% yield as well now. So that reduction in total supply of ETH helps all ETH holders, regardless of if they're validated or not. So what I really enjoy is the fact that with most fee markets in blockchain, the only way to really keep growing is to mine. And then with Ethereum, you have LPing, but again, the only way to increase your ETH stack is to LP ETH to DAI or ETH some other alt. And that's why I didn't really do it for a while. But now I do it because you can get uni in it. It cuts out some impermanent loss. But what I'm super excited for with ETH2 is there's finally a way for users of a network to simply have ETH, make more ETH, no need to mine. You can just hold ETH. And so these derivatives of ETH are going to allow people to hold any amount of ETH, gain more ETH, and continue using ETH. And I just love that idea. So conclusions and recommendations, I will read through this quickly because I want to get this paper done. And I'm so close. So chapter 11. And so I might try to remember where this was. So I'm going to try and go to my YouTube and maybe even add a stream marker. Because apparently if I had a stream marker, I should be able to come back to this video and in my stream say, oh, chapter 11 now. So we'll see. But it's been 37 minutes. I might manually have to do that anyways. Just remember that I went through. In this section, based on the analysis conducted throughout this chapter, we summarize our conclusions around the design objectives, economic positives, and risks of the ETH2 network, and provide our recommendations for further explanation. Design and objectives. Ethereum 2's proof of stake is highly complex relative to proof of work. ETH2 is a highly complex and elaborate system. On one hand, we recognize and appreciate the amount of care and thought that has gone into its design. It is an elegantly constructed system. On the other hand, from a validator's perspective, it is difficult to wrap one's head around the extent of its many functions and variables, contributing to a sense of uncertainty around the system's risks and a sense of unpredictability around the system's outcomes and future. I live across the street from the Detroit River, and there's the border bridge, and so lots of trucks all day and boats all day making noise. But anyways, moreover, this unpredictability coupled with the phasing of ETH2 into at least 3 phases presents a narrative problem for Ethereum relative to other crypto assets, which cannot be overlooked given the system's dependence on price, which is market-driven for security. I don't see a big issue here necessarily because ETH1 has a pretty strong price and strong market history. But it is important, obviously, to keep the price of ETH2 high as well. This sentiment was strongly echoed by institutional stakeholders we interviewed. In short, the complexity and uncertainty surrounding Eth2 presents a barrier for potential capital-efficient validators. Also, this paper came out in July 16th, I'm pretty sure, of this year. And so it's been a few months since then, and a lot of these questions have been, maybe not answered, but cleared up a bit over the past few months. Security of the network is dependent on three key variables: ETH stake, the price of ETH, and volatility. Each of these variables has a direct or indirect impact on the cost of attacking the network. Total ETH staked is the most controllable variable, with the main lever being the incentive mechanism centered around the base reward factor. The higher the incentives, the higher the yield, and the more attractive to stake ETH, more secure. The price of ETH, on the other hand, has a direct and potentially large impact on the network security, but it's outside the control of the system. That being said, certain forces can create upward price pressure. For example, if ETH is held mostly by long-term holders, we would expect velocity to decrease. Moreover, high yields from ETH2 staking could push ETH holders to shift their ETH from ETH1 to ETH2, decreasing the circulation supply of ETH, which would be a good thing for the ETH price. However, the positive impact to security from this shift could eventually be balanced by the likely increase in volatility as a result. Volatility, our third key variable, can come from different sources and impacts both ETH staked, though required rate of return as demonstrated by the R-Savvy model, I went through that in the last video, and price of ETH. An optimal balance between scarcity and volatility could theoretically be defined as the maximum marginal security per ETH minted, which, hopefully we can get there to that, or close to that point. We encourage further exploration of this marginal security theory to augment decision-making around network economics, which can be supplemented by tools such as R-Savvy and validator duration, Appendix D. Attacks on Eth2 are easier to scale than on Eth1. We went through that already. We'll go through it again here. In Eth2, the physical and hardware-driven burdens of the network participation recede to essentially minimal hardware and power consumption. It is likely that even Raspberry Pis eventually meet the machine requirements of managing validator nodes for hundreds of thousands to millions of dollars worth of ETH. Scaling validation environment shifts from ordering, configuring, and operating mining rigs to simply purchasing more ETH, which is super exciting for barriers to entry being lowered. Moreover, the flourishing of DeFi and eventual connectivity to ETH2 can vastly accelerate and magnify this trend. So, for example, capital-efficient attacks can be something as simple as, controlling a bunch of nodes, causing them not to be able to attest, causing an activity leak, which would cause a bunch of people's ETH to be burned and lost, and cause the network to not finalize, which would probably ruin the price of ETH short term, which could be, you could make money by shorting. And then I would assume that all that ETH burned would increase the price of ETH in the medium to long term. And therefore, someone could short the ETH network, buy a bunch of ETH at that low price, start validating with that large amount of ETH, and then control, by one major attack on the network, control a large part of the network. And I think that's kind of the issue with all this connectivity and composability. And one that will only get more complex as we advance to further phases of Eth2 and expect more innovative development in Ethereum-based financial instruments. And I think this is the craziest part. As blockchain-based dApps get more and more and more complex in terms of finance, it's all just so interconnected. I mean, my Ethereum wallet now is connected to anything I want it to be. I can loan, I can borrow, I can play video games, I can do a lot from my Ethereum wallet. And I think soon I can validate as well and support the network in terms of security. Capital efficient validators are necessary and more predictable. I think both that is very true. We expect many they call it yield insensitive validators to participate in Eth2 validation, particularly during phase 0. Woohoo! This is important to be for a successful beacon chain launch. However, yield apathetic participation is ultimately inadequate to reach sufficient levels of security and can lead to unpredictable network security conditions for many reasons. But yeah, the main reason is it's hard to understand why all these validators are staking or less staking or exiting. So it's hard to write a paper and create incentivized structures around that. Whereas capital efficient validators are singular in their motivation. return net of risk. So they want to return on their investment without a lot of risk. And so creating a system for those people at least allows for Ethereum 2 to be very, very, very secure. And then after that, you can build whatever you want, add apathetic validators as well. We find tailoring the incentive lever to the capital efficient validator's motivating factor leads to a higher fidelity in targeting a total ETH staked number. Targeting 50% ETH staked will match security levels of ETH1 at historical price levels. I think that's very important because we're talking about historical price levels here, meaning that this 13.8% number is probably very high for the current price of ETH. I think the historical price uses like anywhere from $25 to like 300 or something like that, and so they average it around 200. They go from like 100 to 300, averaging 200. I think I can't remember from the paper specifically, but either way, I would consider an average to be more like 200 to maybe 400, and so this number is probably a bit high, but still better to be safe than sorry. So, economic positives. Economies of scale for validating exist, but decrease at higher ETH price. We talked about this as well. Unlike POW environments where profitability can only be accomplished by increasingly large-scale operation, which stopped me from mining for a long time, Eth2 validating graduates into an inexpensive operation relative to revenues as the price of ETH increases. Woohoo! The details of profitabilities between scaled cloud environments operating hundreds of validators, staking as a service providers, and individual validators using select hardware close in on zero as ETH exceeds $1,000. So, as ETH gets to that $1,000 mark and exceeds it, it doesn't really matter how you validate, but if you're involved, pretty much your costs are pretty much zero because your rewards are so much higher. Irrespective of price, there are also minor economies of scale for large-scale validators, as potentially thousands of validators can be run from the same beacon node. However, we view these as too minor to represent a real competitive edge. In general, we find the network economics highly favorable for more decentralized network participation, meeting ETH2's design objectives, which is awesome. I'm starving, by the way. I haven't eaten yet today. I'll do that after this paper. 77.7% of current ETH supply is in valid or qualified wallets, hovering over 32 ETH, which is a good thing. Approximately 86.6 million ETH is being held in non-exchange wallets over 32 ETH. Another 18.7 million is managed by exchanges, which might offer staking services, which I would suggest, most of that ETH, or at least a good chunk of the ETH, will start there and they'll grow over time. This is a compelling, serviceable, addressable market. Focus on the incentive mechanism should be converting this share of qualified ETH into staked ETH, of course. What I think is really cool is that it doesn't really matter. It should, yes, focus should be converting this qualified ETH because it's so much. But I think there's also a lot of that means that 22% of the total supply is held by people who don't have that much, which means there's a lot of people who would want to get involved potentially and can't. So I think there should be some sort of focus on how do we get these unqualified validators somehow supporting the security of ETH, ETH2. So, maybe holding our ETH, maybe providing liquidity for our ETH and these derivatives. I think there's lots of ways to get involved, and I think that right off the bat, obviously, making sure that as much of this 86 million comes over as possible is great. But remember, initially, only 15.5 million ETH is needed for pretty good security, right? So this 15.5 million stake is all that's needed. So, potentially going after this 86 million is not that necessary. There's enough ETH just held in wallets with under 32 ETH to hit that 15.5 mil target. So potentially, what I would love to see is how many validators hold 16 ETH, right? And then so how many validators, how probable is it for a service like Rocket Pool, for example, to be able to hit the entire amount and keep a strong ETH2 network? Because if you have Rocket Pool and you have NIM and Status providing a STAS and a non-custodial decentralized service and others, I think that might be enough right there. Using current beacon chain specs and 15.5 million staked, we estimate network inflation of 0.55% per year, far less than the current 4 to 4.5% of ETH POW network. So pretty much you'll get similar or more security, and you're paying a lot less for that security. In terms of dollars spent on security, we estimate at $200 ETH that ETH will pay $1 billion in security versus 125 million here. That's a huge difference. Almost what, like 10% of the price for the same amount of security or more. So this is the inflation rate shown in the graph. This is the amount you spend on security by the price, yada, yada, yada. ETH pays too much for security. And what's crazy is that ETH was paying 3.5 billion for security in 2018 in that bull market, which is insane. I don't think it's that insane now. If anything, I think it's a bit low now considering all the economic activity you have on ETH. But anyways, almost done. Okay, economic concerns. Network securities heavily reliant on the price stability of ETH are permanently concerned with regards to the economic stability and security of Eth2 is the reliance of the network at low ETH prices. Profitability diminishes, which could force validators to exit, further diminishing security. The cost to attack the network also directly and materially decreases, impacting the total ETH price and total ETH staked, and causes uncertainty for the validators that remain. Wait, the cost to attack the network also directly and materially decreases. Oh, yeah. The cost to attack the network decreases. So if you stay in the network, you feel uncertain, like, okay, as the price goes down, attacking the network gets easier, so there's more and more risk involved. Combining these low ETH price impact, the low end price impact, with the ability for an adversary to rapidly scale an attack on ETH, there's a concern. So as well, again, I was kind of putting all three of these into the same attack, but causing some attack that drops the price of ETH, and then people will leave the network and cause more price disruption. And if you're shorting the whole way down, you have more money, you buy a bunch of ETH, and then you could rapidly scale another attack. Or just the idea that you could scale an attack with your ETH. Anyways. The lack of liquidity in phases 0 and 1 might cause unpredictability and centralization. Given the lack of a two-way bridge between ETH1 and ETH2, the lack of transaction capabilities in phases 0 and 1, we expect staking to appeal only to a subset of the total addressable market for validators in these phases. Derivatives and centralized exchanges could provide a secondary market, which might be more compelling for investors looking to gain exposure without incurring roadmap risk or other uncertainty. I think this will be huge. I think that institutional investors are not going to touch running their own actual hardware setup anytime soon, but I do think institutional investors might buy a bunch of our ETH and try and get some exposure to that yield. A high concentration of validators leveraging these platforms creates centralization risk and unpredictability, both for commercial policies and how SaaS providers might react to uneconomical conditions. Beware of derivative attacks. The ETH ecosystem is rapidly evolving, and so is Ether as an asset class. At the time of this writing, there are over $2 billion locked up in DeFi protocols. It's much more now. And the total ETH trading, I think it's almost 12 now. And the total ETH trading was almost $2 billion just in Uniswap. And the total ETH trading volume year to date in June has already exceeded 2019, and it's 3 times 2018, and it's 10 times 2017. So these numbers are way out of date now, but I think that goes to show how important this is. Options are currently being structured and sold on platforms like Deribit and OKX, and unique financial instruments like flash loans are being used in malicious exploits. And those I think Harvest Finance got hacked or exploited a couple of days ago for 25 million. It's a pretty complex exploit, but the idea is these complex exploits are not going to stop anytime soon. And if someone can mint a bunch of ETH in some platform and use it to get for example, that 25 million, in my opinion, if you used that to go through a mixer or something and start staking, and no one knew who you were, you found a dark staking pool, you would never need to exit the network. So you could do a $1 billion hack and then use that $1 billion of ETH to stake. And you would own quite a large amount of the network. So I think the only real solution to these attacks is, I mean, it's kind of weird, but the price of ETH kind of, I don't know. It's going to be interesting to see how that plays out with, you have one large hack, you have hundreds of millions of dollars potentially, and then you can just stake forever and always get rewards and own a large part of the network. So it's going to be very interesting. Recommendations. Increase the base reward factor to at least 128. I agree with this wholeheartedly. After going through all of the graphs and the paper, I definitely agree with increasing this base reward factor at least by double. When you look at how low it increases issuance, and with a high ETH price and a high amount of transactions, an EIP 1559, and you see how this increased reward factor probably won't even change things much in terms of inflation once EIP 1559 is out, I think it's definitely a great idea. To reach the total F stake target of 13.8%, the network would need to be in an optimal state with negligible risk cost or opportunity cost for validators to consider the investment an efficient one. We acknowledge the implications of increasing the network's payment for security, but at a base reward factor of 64, we believe the network is underpaying for security. And I think this is 100% true. I think with all these, again, with flash loans and all these DeFi derivatives and all these different pathways happening on Ethereum, it's wonderful, but I think being way more secure is more important than trying to, underpay and try and get this like really good economic system that you're underpaying and all of a sudden you get hacked or there's an exploit. That's not what you want. Okay, and it would be prudent for the network to err on the side of caution during its phased migration to proof of stake, particularly as we find the additional issuance implied well within the bounds of reasonable inflation. Agreed. Explore a more dynamic method to changing the base reward factor in the event of shock. Ooh, I really like this. The fact that the base reward factor might be able to change would be cool. As mentioned in the economic concern section, the primary state of an economic distress, in our view, is when the ETH price falters and the network takes a moment to reset and stabilize at a healthy level of ETH staked. The network is prone to vulnerability during this time. We recommend exploring a more dynamic method for scaling rewards or altering the base reward factor in the case of network shocks. So I guess this would be if ETH price drops considerably, you would increase the base reward factor. For example, one could consider setting threshold triggers in the case of a mass exit, where the queue for exiting validators is a factor of changing base rewards. Cool. Alternatively, one could consider a step change function based on the levels of ETH stake. That's what I would think. Just very simple, nothing kind of too algorithmic or too complicated in terms of algorithms. To maximize yields up to the ETH stake target we identified above, while reducing yield substantially beyond that point. Lastly, one could even consider an incentive function that is not exclusively tied to ETH staked or validators, but rather price itself. This, of course, introduces Oracle dependence risk, which is not fun, but we encourage further exploration of this topic. In any case, we recommend using phases 0 and 1 to further test the incentive mechanism and staying agile and open to further changes in reward structure to respond to new data points. And so the recommendation here is to use phases 0 and 1 for experimentation. And in my opinion, that's what it is. Phase 0 is full out experimentation. Do not touch it if you are not someone who's okay with experimentation. Phase 1, in my opinion, is where it's less experimentation and more trying to finalize some sort of spec for how transactions and how phase 2 might work. And then once you get into phase 2 and you add in transfers and account and all that kind of craziness, in my opinion, that's when you're at your live. You can't make a mistake in phase 2. So phase 0, you don't want to make a mistake in phase 0. You want to get the beacon chain launched and get things going and get it running. For phase 1, in my opinion, it's a huge experimental phase. Once phase 0 launches and beacon launches, I think we have a long period of experimentation where all we need is a high level of security to experiment on top of. And once we have that and it's all good and we think, okay, you know what? Ethereum 2 phase 1 is going well. It's going strong. There's no big hacks, no big exploits. Then I think going into Eth2 phase 2 is a reasonable idea. And even then, I mean, day one of that could cause a huge hack. So I'm assuming there'll be test nets of that for a while before it even got onto any kind of mainnet. But finally, we reiterate that given the complexity of the system, further analysis and more dynamic models, example, agent-based models, could help identify further attack vectors and economic risk. We encourage the continuation of these analysis and hope this paper can serve as a helpful starting point for further research along these lines. So I finally finished the paper, only 86 such pages. There's a lot of papers in the bibliography here that I do want to go through. And so I'm going to leave this for today. There's a lot of really cool papers here, like there's the history of Casper paper in a Medium post. I think I've read through the sharding facts. I never read through this. I read through the ETH2 specs. Like this State of Ethereum, the Beacon chain from 2018. I definitely haven't read that. Like, that's so old. So a lot of these are older papers that I definitely. Oh, so combining Ghost and Casper. I went through that paper on this channel last week. Let's see. The Beacon Chain Explainer you need to read first. I haven't read that. So, for example, I'm just going to open up some papers that I might read. Oh, gosh, there's so many. Maybe I won't. Maybe I'll do this later. I think I'm just going to end this paper for now. I'm trying to figure out what papers I want to do next. So, as you can see, there's a bunch of papers. In this bibliography and the appendix and the user surveys I actually want to read through. So I'll probably do a live stream maybe tomorrow or the day after, going through the appendix and like the ending of this paper, kind of like what are some attack vectors in the Ethereum wiki. Probably just spend an hour just digging through some of this information. And then my next paper will probably be a paper from the Consensus Diligence email that I sent out for the month of October. There were some really cool papers on there, and so I'm probably just going to look through it live and pick a paper. That should happen today, actually. Today I'm going to pick a paper from Consensus Diligence, but that is all for the Eth2 Economic Review actual paper. Thank you anyone who has gone through this far into the paper review. Again, if you got to this point, this is the only video you've watched. I did a whole series on this. Please feel free to read it yourself. If you have any questions, comments, concerns, leave them here, I guess. I'm not really the person who wrote this, so you can leave it for the actual researchers as well. But yeah, that's all from me. Hope everyone has a wonderful day. That's it. That's all here from Chloethedev.